To start, can you introduce yourself and also the team that support the US small cap growth strategy?
Yeah, my name is Christopher Berrier. I've had the pleasure of managing the US small cap growth strategy for quite a long time, along with George Sakalaris and a broader team of analysts who cover all of the major sectors of the US economy. We are divided into sector teams. There's 3 or 4 teammates per sector. They are charged with going out and digging and finding the most pertinent information in their area of the market, connecting the dots, and then having their best thinking reflected in the underlying portfolios that we manage as a firm. I would tell you first and foremost that when we talk about the strategy, the foundation of everything we do is the team. Without having the right people in the right seats, your chances of success are very, very low.
And maybe a good place to start is, what's the opportunity in US small caps?
There's a massive long-term opportunity and one that's been enduring. There's a couple thousand companies in the US to choose from. And the US is obviously a pretty vibrant economy historically. There's a lot of new business formation, not just out of Silicon Valley, but these days via technology all around the country. And that's our opportunity set, one that's 2,000 companies and growing. And our biggest challenge is not finding stuff to buy, it's narrowing down that list into a select few businesses that we're focused on, which are those that can grow from being small cap into mid cap companies, and if we're a little bit lucky, into larger cap businesses over time. So I think the value of being a US investor in the small cap space is you have a huge universe. There are tons of businesses that have gone historically from being relatively tiny to extraordinarily massive, and we don't have to get them all right. If we can just find a few of those within the 2,000, that is enough to drive a portfolio, not only on an absolute basis, but on a relative basis as well.
Maybe you could just give us a brief overview of the strategy itself.
What we are attempting to achieve is to drive higher returns with slightly less risk than the benchmark over a long period of time. Our goal is to try and drive 100, 200 bips per annum and do that over a full market cycle. So we are not attempting to divine what is the next great area of the economy that's going to work and put all our chips there. We're trying to find best of breed businesses in each area of the economy, have the strategy largely be diversified so that it can be something that is quote unquote all weather. You can buy it, own it as a part of your broader portfolio, and hopefully our solid bottom-up stock selection will allow us to achieve the returns that we want and we know our clients expect and deserve. That is one way for us to harness the power of compounding. It's a way to deliver better than average returns and do it in a manner whereby we have a high quality portfolio that will probably do reasonably well during periods of stress because of the types of businesses that we're owning. And therefore, we can get that best of both worlds, which is hopefully above average returns with a little bit less risk.
And how do you really identify those companies, and what is it that you're specifically looking for?
The challenge again is that we've got 2,000 businesses and we have to narrow it down. So there are a lot of things that we avoid. Things that are more science projects, highly speculative, those largely fall out. Things that are incredibly commodity oriented, where it's purely an economic cycle that's driving the business, those can be avoided. But then you really get down to still quite a long list of businesses that we have to choose from. So when we start diving into the companies, we're really looking for 3 things, and we refer to it as the 3 Gs, mainly because it's simplistic. We're looking for durable growth, sound governance, and scalable go-to-market strategies. And I won't get into depth in each one of those, but in order for a business to go from being small to mid to large, you have to be able to grow at an above average rate for a long period of time. And that's why we're looking for durable growth. We want larger markets relative to the revenue base of a company that enables a runway to grow. And if that company is doing something differentiated, allowing it to take a larger slice of a growing pie over time, that even sweetens the pot, and that enables the growth to be even more prolific than we originally thought. The second piece is sound governance. Now, obviously, what we're trying to achieve with the businesses we're invested in is essentially value maximization over the long term, right? Not short-term compensation maximization, which can sometimes happen within the corporate businesses in the US. So we want a diverse board of directors with the requisite knowledge and experience to help guide the management teams. We want CEOs, CFOs, et cetera, that we think are capable, honest people and aligned with us. And we would hope that that alignment is what drives an outcome that is both acceptable to us, our shareholders, and them as a management team and a board. And the final one is go-to-market strategy. So this is something that's going to come up in every single analyst day that our companies have. And when we think about the businesses we're investing in them, many of them are subscale. They're not quite large enough to be at their target business model. And so when we talk about scalable go-to-market strategies, what we're thinking about is really in terms of unit economics. If you sell one widget, what does a company look like? What about 10? What about 100? What about 1 million widgets? How profound is the change from sort of startup mode to being a much larger company? And what does that mean for the financial profile and what might people pay for it? So if we can find what we think is a large end market that a company can grow into, we like and trust the people, and we think that the unit economics can scale through time, those are the businesses that we want to invest in. No company is perfect, so you don't get a 10 out of a 10 in each of those, but you want to make sure that fundamentally a company has those ingredients, because when it does, it frankly just has a higher probability of making the journey from small to large cap than the rest of the field.
And what is it about the strategy and then also the Brown Advisory platform that you really think sets us apart versus peers?
Well, I think the good news is that as Brown Advisory has gotten larger, we've invested behind that growth. So the team of analysts and portfolio managers has expanded along with the assets under management, which means we have lots of resources to leverage, whether they be at the sector level, whether it's ESG. I'm sitting in the London office today. I have plenty of colleagues here that are doing work on international companies. So what that means is you simply have a breadth and depth of understanding about all of the companies that are available to you, which makes you more attuned to your universe, which means you might be able to find that next great thing that everybody wants to be invested in. The other nice thing is that as Brown has gotten bigger, our tentacles have extended out into other areas. So our presence in venture capital and private equity has expanded over time. That's a wonderful network for us to leverage because we don't care just about the public companies that we're invested in. We care about their private competitors, and we care about the companies that are going to go public in 2, 3, or 4 years that might be interesting investments on behalf of our clients. And then finally, if you're willing to tolerate slightly higher highs and higher lows in the short run, chances are over an extended period of time, you're going to get compensated for it with higher returns. So we like to think about having small caps as a key part of your overall portfolio and hold it for a long period of time. But certainly it should complement any large cap allocation you have because it simply is governed by different economic and market forces.
And with that in mind, how does the strategy adapt to behave in different market environments, economic cycles?
Well, we have some tried and true things that we don't alter because the world has changed. So there's philosophical elements to what we do, the types of businesses we look for, the types of people we want to invest behind, the type of return versus risk that we're seeking out with initial investment. Those are constant and they're not going to change. And I think we've been doing this 16, 17 years under this philosophy, and I think it's one that can endure through time. Now, we have to be open to the fact that the world changes, and it's certainly changed a lot in the last 10 and certainly in the last 20 years, where economic cycles are different, investor behavior and the types of vehicles they invest in are different, and we have to make sure that our mindset adapts to those changes. One of the things we've realized is that speed and being relatively more aggressive today is very important. So speed of action, speed of thought process. We need to get in when we have an opportunity, and frankly, we need to get out when we have an opportunity.
And then finally, just to give a bit of insight into yourself, is there anything that viewers might not know about you as an investor that you would share?
Sure. I think over the long term, I've grown as an investor just because I have more experience. I think you don't know how much you don't know when you start out as a portfolio manager and analyst. You only figure out how clueless you were with the benefit of hindsight. And I think now, having been through multiple different cycles, watching multiple different market routes, watching different types of companies flourish and fade, you have a greater appreciation of how hard the job is and how humbling it can be at times.